Hi, my name is Danielle Wiggins. I'm a junior here at Lamar University, and I'm studying nutrition. Today, I was going to speak with you a little bit about the credit card industry. The credit card industry seems to be growing more and more every day. There were a few things that I wanted to talk to you about. First, I wanted to explain what a credit card is, how credit cards make their money, college students and credit cards, and how to keep a credit balance low. A credit card is a small plastic card. It looks very similar to a debit card, and it allows you to borrow money from a bank or a business and pay back the balance each month. MasterCard claims that the first bank credit card was named Charge It. Charge It was introduced in 1946 by John Biggins in Brooklyn. When customers used it for a purchase, the bill was then forwarded to Biggins Bank. The bank would then reimburse the merchant and obtain payment from its cardholder. Some people wonder how credit card companies make their money. If a cardholder is simply paying back its loan each month, then how is anyone making any money? Well, credit card industries make their money on interest. They collect interest payments on people who don't pay their balances in full each month. Consider this. In April of 2014, the average American household held $15,191 in credit card debt. At the same time, the average credit card interest rate is around 15%. Say you begin 2014 with a credit card debt level that is at the national average, and you're using a card that charges the national average in interest rates. If you're only making the minimum payment on your credit card, 6 months into the year, you will have paid your credit card issuer about $1,100 in interest only. You will still have to pay off the remainder of your balance while it keeps collecting interest if you're only making the minimum payments. There are several other ways credit card companies make money. Several of them include annual fees, cash advance fees, balance transfer fees, and late fees. And annual fees are fees that customers pay every year in order to keep their account open. Not all credit card companies charge an annual fee, but usually if you're going to get a credit card that offers rewards, they're going to have a pretty big annual fee on there. Cash advance fees. Users charge these fees when a customer takes a cash advance from their cards. A cash advance is when you take your credit card to an ATM to take cash out like a debit card. Most interest on those kind of transfers are in the amount of 2% and 5%. Balance transfer fees. These fees are assessed when you move debt from one card to another. The fee is usually charged by the card you're moving the debt to. Most banks charge around 3% of the total balance transferred. Late fees. Making a late credit card payment is costly to your wallet and costly to your credit. Most credit card companies charge a $25 late fee for the first offense and $35 for a subsequent late payment. Try to avoid making late payments in order to not break the bank. College students and credit cards. Recent studies show that the Credit Card Act slowed the rate of college students obtaining credit cards. College students in America were racking up some serious credit card debt. Now students must be at least 21 years old unless they have an adult cosigner or they are able to show a significant income to back up their loan. With the Credit Card Act reducing the availability for students to obtain credit cards, the amount of student debt on credit cards has been significantly reduced. How to keep your credit card balance low. Pay your bill on time and avoid late fees. Be on the lookout for new fees. Try to pay off as much as your balance as you can to avoid taking on so much interest. Make sure your balance is less than 35% of your credit line to avoid getting in over your head in some debt. Thank you so much for allowing me to speak with you about credit cards. If you have any questions or concerns, I'll gladly take this moment to answer any of them. Thank you.